Amateur stock picking is often a blur of chasing headlines and reacting to emotions. Professional trading relies on snapping that chaos into a strict grid of entry points, targets, and risk limits. Today, we are applying that structure to Netflix. The market is currently trying to price in a dense knot of new data for the streaming giant, ranging from immediate revenue shifts to major tech acquisitions. Our objective here is to cut through the noise. We are going to isolate the math and build a hypothetical end-to-end trade plan based strictly on the data. If you want to follow along, grab a physical notebook or open a digital trading journal. We are going to calculate and document specific entry and exit parameters. Writing these numbers down in advance is how you strip emotion out of the equation. When volatility hits, a predefined framework protects your capital. The first factor driving this setup is an immediate revenue play. Netflix is aggressively testing its pricing power with new subscription hikes. This graphic maps out the March 26th rollout. You can see synchronized price increases hitting all three tiers: ad-supported, standard, and premium. Wall Street typically rewards this maneuver. When a company can charge its user base more without triggering a mass exodus, it demonstrates pure pricing power and immediately pads the bottom line. The second driver is a massive tech play aimed at the production side of the business. Netflix just executed a $600 million acquisition of Interpositive, an artificial intelligence startup founded by Ben Affleck. The goal here is to integrate AI directly into the post-production pipeline. By automating heavy editing tasks, they plan to significantly cut studio costs and accelerate content delivery. We have immediate top-line revenue growth from the subscription hikes, paired with a long-term strategy to reduce content costs using AI. This creates a highly favorable dual catalyst environment for the stock. Headlines alone aren't enough to trigger a trade. We need to measure how the market is actually pricing those catalysts right now. As of the latest close, Netflix is trading at $93.43, commanding a massive market capitalization of nearly $394 billion. This chart illustrates a clear shift in valuation. The trailing price-to-earnings ratio sits at 36.97, but the forward PE steps down significantly, dropping to 24.43. This compression tells us analysts are modeling in heavy earnings growth over the next 12 months. Institutional sentiment aligns closely with that growth model. We are seeing aggressive upgrades across the board, including a $115 price target from Citi and JPMorgan raising its target to $120. But a rigorous setup requires checking our blind spots. We have to verify if the people actually running the company are buying into this exact same bullish narrative. We found a major conflicting data point. Director and co-founder Reed Hastings recently executed a massive stock sale, cashing out roughly $40 million in shares. Professional trade structuring requires holding both of these realities at once. We have to weigh Wall Street's aggressive price targets against the reality of insider profit-taking to accurately gauge market conviction. Before a single dollar is allocated to this idea, we have to establish strict rules for capital preservation. The golden rule of position sizing for a swing trade is absolute. You never risk more than 1 to 2% of your total portfolio capital on a single setup. Let's translate that into concrete math. If you are trading a $10,000 account, your maximum acceptable loss for this entire Netflix trade is exactly $100 to $200. To execute that safely, we use a technique called scaling in, rather than deploying our entire allocation at a single static price point. You buy half of your intended position at your initial entry point. You only add the second half if the stock proves your thesis by confirming the anticipated uptrend. Without enforcing these specific sizing and scaling parameters, hitting the buy button is merely gambling. Mathematical risk limits are exactly what separate professionals from amateurs. Look at this 5-step blueprint template. Finalize your trading journal, and let's synthesize all of this data into a final, actionable plan. We are defining this specific strategy as a post-catalyst consolidation swing designed to ride the momentum from the recent revenue boosts. Our exact buy zone sits tightly between $93 and $94, capitalizing on the stock's current consolidation around that $93.43 mark. We are setting our primary profit target at $113.32. This utilizes the consensus institutional price target to capture roughly 21% upside. Finally, we map our non-negotiable stop loss at exactly $88.50. This gives the trade 5% breathing room while guaranteeing an immediate exit if the thesis breaks down. You now possess a fully risk-adjusted, emotionless trade setup. Set your price alerts, watch the market tape, and strictly follow the numbers in your plan.